Welcome to the deep dive. We know you've got a ton of information coming at you from all sides, right? Articles, books, podcasts, the works.
Absolutely.
Our mission, our whole thing with the deep dive is to wade through all of that, pull out the really important stuff, and figure out not just what happened, but why it matters. And this deep dive, this one's for you.
That's right. Today, we're taking a deep dive into the world of money. Finance, the whole shebang.
We've been digging into this really interesting book called How Money Works, The Facts Visually Explained, and Our Goal, to give you a clear, engaging, and maybe even a little surprising understanding of how it all works. We're not just skimming the surface here.
No way. We're going deep. We're talking about those fundamental concepts, those building blocks of the financial world, from the very first time people traded stuff to the crazy systems we have in place today.
Think about it. From trading a cow for some wheat to trillions of dollars zipping around the globe as digital data.
It's mind-boggling when you think about it.
It really is. We're going to trace how money evolved, how these big financial institutions work, and what role governments play in shaping the way we use money every single day. So before we get ahead of ourselves, let's rewind all the way back. Forget about dollars and cents, forget about credit cards even.
Okay.
Let's talk barter.
Barter, that's where it all started, the original trade.
Right.
You've got something, your neighbor wants it, they've got something you want, it's a straight-up swap. You have a cow, they have a ton of wheat, you agree on the value, boom, exchange done. Simple.
Direct. But what happens if the timing's off? What if your neighbor doesn't need a whole cow right now?
Right.
Or their wheat isn't ready for harvest yet? That direct swap gets messy.
Totally. And that's where the idea of something beyond barter comes in. Instead of an immediate exchange, you might agree to a promise, like an IOU. Hey, I'll deliver that wheat next month when it's harvested.
And the cool thing is, those IOUs didn't have to be for the original thing, right? They started to develop their own value.
Exactly. An IOU for wheat could be used to pay for, I don't know, building a fence or maybe even getting a bunch of apples from someone else. It became a stand-in for actual goods, a symbol of value.
So we're not talking about trading actual stuff anymore, but these promises, these representations of value.
And that right there is a massive shift, because think about it. Money, at its core, is basically a universal IOU, something everyone agrees has a certain value.
So you can trade it for anything else.
Precisely. That shared agreement, that's the key.
Okay, so now we've gone from physical goods to these promises, these IOUs, but I'm picturing everyone running around with scraps of paper saying, I owe you one used axe. That can't be how it was for centuries, right?
You catching on. The next big leap was the invention of coinage. This was around 650 BCE over in Lydia, which is modern-day Turkey.
Okay.
They started using these little metal discs as formal tokens of value, mostly gold and silver.
So not just any random chunk of metal, right?
Yeah.
These coins were standardized.
Exactly. Specific weight, specific purity. And usually, they were issued by a king or a government, to add that extra bit of trust.
So these coins weren't just valuable because of the metal itself, but because they were official. And this whole coinage thing, it lasted for a really long time, right?
Oh yeah. For over 2,000 years, coins made of gold, silver, sometimes copper for smaller transactions. That was how people primarily exchanged value. It's crazy when you think about how long that system lasted. It really shows how much people trusted these physical tokens.
Okay, so if coins were the main game for over 2,000 years, what eventually came along and took their place? Paper money had to enter the scene eventually, didn't it?
Of course it did. Enter banknotes. They started popping up around 1100 CE. Now these, at first, were basically paper IOUs, issued by states or these early banks, promising that you could exchange them for actual coins whenever you wanted. So the value was still tied to precious metals, but paper was so much easier to handle, especially for bigger amounts.
Try buying a house with a sack full of gold coins. Not exactly convenient.
Right. So paper money brings convenience, but even that seems pretty outdated now with all the digital payments and online banking we do.
Which brings us to the digital age of money. This really took off around the year 2000.
Yeah.
Now money mostly exists as data on computers. We can move huge amounts of money around the world without ever physically touching it.
It's wild.
The estimated total amount of money out there today is something like $80.9 trillion.
$80.9 trillion. And a vast majority of that is purely digital. It really shows how abstract the concept of money has become.
From cows and wheat to lines of code, it's quite a journey.
So, we've got this increasingly abstract idea of money. how do markets and the whole profit motive fit into this system?
Yeah.
It's not just about individual people swapping stuff anymore. It's entire economies.
It's all connected. By the 18th century, people were starting to study how individual decisions about buying, selling, and investing impacted prices and wages across entire countries.
And this is where Adam Smith comes in, right? Adam Smith, the big name in economics, the invisible hand guy.
Well, I do, but for our listeners who might not, can you give us a little recap?
Sure. In his book, The Wealth of Nations, which came out in 1776, Adam Smith argued that the government didn't actually need to control things like wages and prices for society to run smoothly.
Okay, so why did he think that? What was his logic?
He believed that when people act in their own self-interest, trying to make their own lives better economically, it actually benefits everyone. Like this big complex dance where everyone's focused on their own steps, but somehow the whole routine comes together.
The pursuit of individual gain in a free market ends up benefiting society as a whole. So if there's a high demand for, say, incredibly comfy slippers,
Okay, I like where this is going.
people will start businesses to make and sell those slippers because they want to make a profit.
Right.
And in a competitive market, the desire for profit will keep those prices reasonable because no one wants to be undercut.
You got it. Competition acts like a natural regulator, keeping prices from getting too crazy. And that profit motive ensures people make the stuff everyone wants and needs. It's a self-regulating system, at least in theory.
Fascinating. So individual actions driven by self-interest collectively shape the market.
Okay, let's talk about something that has a huge impact on the value of money itself. Supply and demand.
Supply and demand, the backbone of economics. Pretty straightforward when you break it down. If there's not much of something, the supply is low, but everyone wants it, the demand is high, then that thing becomes more valuable.
Makes sense. Like if there aren't many dollars circulating, people will be willing to trade more of their stuff or work more hours to get those scarce dollars.
Exactly. That's why that thingamajig that normally costs $10 might jump to 15 if everyone wants it, but there just isn't much money going around. On the flip side, if there's a ton of money available, but no one really wants it, the value drops.
It takes more money to buy the same amount of stuff. This is basically what inflation is, right? You got it. We'll dive into that a bit more later. But there's a cool historical example of this, remember? When all that silver flooded into Spain from the Americas in the 16th century.
Oh yeah, prices went up.
Big time. People back then noticed that all that extra silver led to a general rise in prices across Spain. It was an early, real-world demonstration of how increasing the money supply can decrease its value.
Okay, so the amount of money available and how much people want it directly affects its value. How do interest rates fit into all of this? You always hear about interest rates in the news.
Interest rates are basically a lever that can control both the supply and demand for money. When interest rates are high, saving becomes more appealing because you earn more on your money just sitting in the bank. At the same time, borrowing becomes more expensive, so fewer people take out loans.
Okay.
This combination tends to lower the overall demand for money in the economy because people are more inclined to save than to spend.
Right. If my savings account is giving me a great interest rate, I'm going to leave my money there and watch it grow. And if it costs an arm and a leg to borrow money for a new car or a house, I might put off those big purchases.
Makes sense, right? Conversely, when interest rates are low, saving is less rewarding because you earn less interest. But borrowing becomes cheaper, so people are more likely to take out loans and spend or invest. This boosts economic activity, but can also lead to inflation if things get out of hand.
Got it. High rates encourage saving, low rates encourage borrowing. So let's shift gears a bit and talk about the world of business. How do companies actually generate profit? And how can investors figure out if a company's doing well financially? This brings us to corporate accounting.
Yeah, if you're thinking about investing in a company, you absolutely need to understand their financial situation. You want to see how well they manage their expenses and whether they're bringing in enough revenue to actually make a profit and be sustainable.
And net income is one of the key metrics for that, right? Net income, the bottom line, is crucial. It basically tells you how much money a company is really making after they've paid all their bills. It's what's left from their total revenue after subtracting expenses like materials, salaries, taxes, you name it.
So it's the money coming in minus the money going out. What's left is their actual profit. We've got an example here about a property developer.
Right. Imagine a property developer makes $100,000 selling new houses.
Okay.
But they had to spend $20,000 on materials, $40,000 on salaries, and $5,000 in taxes. Their net income would be that $100,000 in revenue minus all those expenses, which comes out to $65,000. So their actual profit from those sales is $35,000.
Okay, so that's how you figure out net income. We also have an example here about a retailer, right?
Yeah, like a clothing store or something.
Okay.
Say they make $100,000 selling clothes.
But they have to pay $10,000 for rent, $30,000 for wages, $22,000 for the clothes they bought to sell, and $20,000 in taxes. Their net income would be that $100,000 minus all those expenses, leaving them with $18,000 in profit.
So net income tells you the real profit a company is making. Now, I've also seen the term earnings per share. What does that tell you about a company?
Earnings per share, or EPS, is another way to look at a company's profitability. It tells you how much profit they've made for each share of stock they have out there.
So if a company has $1 million in net income and 1 million shares of stock, their earnings per share would be $1.
Exactly. Investors use this number to compare different companies and see how well a company's doing over time.
Okay, so net income and earnings per share are important, but are there ways for companies to, make their numbers look better than they actually are?
Unfortunately, yes. Some companies might try to inflate their earnings.
Inflate their earnings? How do they do that?
They might underreport their expenses or include money they expect to make in the future as current revenue.
That sounds a little shady.
It can be.
Right.
It's ethically questionable, and if they're misleading investors, it can even be illegal.
I remember reading about the Tesco investigation back in 2014.
Yeah, that was a big one. Tesco, the huge British supermarket chain, had to admit they had overstated their profits by a lot because they had recognized income too early and delayed recording some of their costs.
It's a good reminder that you can't just blindly trust the numbers companies report. You need to dig a little deeper. So we've talked about revenue and expenses, which lead to net income. But when companies buy big assets like equipment or property, how do they account for that spending?
That's a good question. There are two main ways: expensing and capitalizing.
Okay, explain those.
Expensing is simple. You record the full cost of that asset as an expense in the same year you bought it.
So if a company buys a bunch of new computers for their office, they just record the whole price as an expense for that year.
Exactly. Now, capitalizing is a bit different. If an asset is going to benefit the company for a long time, like several years, you record it on the balance sheet as an asset.
Okay.
Instead of taking the whole cost as an expense in one year, you spread it out over the asset's useful life through depreciation.
So if a company buys a delivery van for $25,000 and they think it'll last for 5 years, they don't take a $25,000 hit all at once.
Right. They might estimate that the van's value will drop to $5,000 after those 5 years. So the total amount they depreciate is $20,000. If they use straight-line depreciation, they divide that $20,000 by 5 years, which means they'd record a $4,000 expense each year for 5 years.
Okay, that makes their accounting look a bit smoother.
Yeah.
But even with these methods, companies can still get into trouble, can't they?
Absolutely. Those big corporate finance scandals we see in the news.
Yeah.
Those often involve companies hiding losses, making loans look like revenue, even straight up lying about their profits.
Like Enron. Their whole accounting scandal was about keeping huge debts off the books. And then there's Bernie Madoff's Ponzi scheme, where he stole billions from investors.
Right. Those cases show how important it is to be skeptical. Investors need to do their research, and auditors need to really scrutinize those financial records to make sure everything's on the up and up.
So it's not just about the numbers on paper. You have to look at the actual flow of money in and out of the business. That brings us to cash flow.
Cash flow is all about that actual movement of money. It's crucial for a company's day-to-day operations. They need enough cash on hand to pay suppliers, employees, and keep the lights on.
Even a company with a healthy net income can run into trouble if their cash flow is messed up.
Totally. Like, imagine a company sells a bunch of products, but then their customers take forever to pay their invoices.
Uh-oh.
Or maybe they have to pay their own suppliers way before they get paid by their customers. That creates a cash flow bottleneck.
And there are different types of cash flow, right?
Yeah, there's operating cash flow, which is the cash from the company's core business, what they do every day to make money. Then there's investing cash flow, which is from buying and selling long-term assets like property or equipment. And then there's financing cash flow, which is about how the company gets its money through debt, equity, dividends, things like that.
So if a company has a good cash flow from their main operations, that's a good sign. What happens if they have a surplus? More cash coming in than going out?
That's a good problem to have. They could invest that extra cash in short-term accounts to earn some interest, or they could reinvest it in the business.
How so?
Upgrading equipment, hiring more people, developing new products, even buying other companies. A cash surplus gives them flexibility and room to grow.
All good signs. Okay, let's talk about how companies actually get the money they need in the first place. We've got this concept of gearing.
Gearing, also known as financial leverage, is all about how much a company relies on debt versus equity.
Equity is the money invested by shareholders.
Exactly.
Yeah.
High gearing means a company has a lot of debt.
And that can be risky.
It can be. A company with tons of debt has to make regular interest payments whether they're making a profit or not. That can put a strain on their cash flow. High debt can also make investors nervous and hurt their credit rating, making it harder to borrow money in the future.
And in a worst-case scenario,
If the company can't make its debt payments, lenders could seize their assets, which could even lead to bankruptcy. Yikes.
not good. What about low gearing?
Low gearing means a company uses more equity and less debt. That's usually seen as less risky because they don't have as much debt hanging over their heads.
Okay, so companies can raise money through debt by taking out loans or through equity by selling shares. What are the pros and cons of each?
With debt, a company keeps more control because lenders don't get voting rights like shareholders. The payments are usually fixed and predictable, which makes planning easier. Debt can also be faster and simpler to get than equity. The downsides are those risks we talked about. High debt can make a company vulnerable, and they have to pay back that loan no matter what.
Got it. What about equity?
When a company issues shares, they're selling ownership in the business. That gives them a big influx of cash without having to make regular loan payments.
Okay.
But the downside is they're giving up some ownership and control. If they're profitable, they might have to pay dividends to shareholders. And unlike debt, shares don't have a maturity date. They're not paid off.
So it's a trade-off between control and the pressure of repayment. It seems like certain industries might naturally lean towards one type of financing over the other.
You're right. Industries that need massive upfront investments, like airlines buying planes, car manufacturers building factories, or construction companies developing properties, they often take on a lot of debt. Those huge initial costs need to be financed somehow, and debt is sometimes more accessible than try to raise a ton of equity.
Makes sense. Okay, let's zoom out a bit and look at the whole financial system. Financial instruments and markets. What exactly are financial instruments?
Think of them as legal agreements that represent money or a promise of future payments, like contracts. They define what each party owes to the other, the amount when they have to pay, whether it's interest, dividends, premiums, the whole deal.
So a share certificate showing you on part of a company, that's a financial instrument.
Exactly. You also have insurance policies, which are basically contracts for future payment if something bad happens, loan agreements, and bond certificates. They can be physical documents, but more and more they're just electronic records.
Okay, so shares and bonds are two of the most common financial instruments. We talked about shares earlier.
Right. When a company issues shares, they're creating these little pieces of ownership that investors can buy. Those investors become shareholders, owning a part of the company.
And they usually get voting rights and maybe even dividends.
Exactly. Shares that are traded publicly on a stock exchange are called listed shares.
And what about bonds?
Bonds are basically loans. When a company or a government needs money, they can issue bonds. When you buy a bond, you're lending them money. In exchange, they promise to pay you regular interest, called a coupon, and then they pay you back the original amount you lent them, the face value, at a specific date in the future.
There's an example here about a water company issuing bonds.
Yeah, imagine a water company issues a bond for $1,000 with a 10% coupon rate, paid annually.
Okay.
That means they'll pay the bondholder $100 in interest every year until the bond matures. When it matures, the bondholder also gets their $1,000 back.
So the yield on a bond, that's the actual return an investor gets, right? And that can change based on the bond's price.
You got it. Yield includes both the coupon payments and any profit or loss if you sell the bond for a different price than you bought it for. If the bond's price goes up, the yield goes down because you're paying more for the same stream of payments. If the price goes down, the yield goes up.
Okay, so we've got these different financial instruments, but where are they actually bought and sold?
That's where financial markets come in. These are platforms where people buy and sell financial instruments. Think stock exchanges, but also electronic networks. The key is that these markets are interconnected globally. What happens in one market can ripple out and affect others.
We all know about the big stock exchanges, like the London Stock Exchange or the Deutsche Börse, but what about the other types of markets?
Right. There's the money market, where institutions and governments borrow and lend money for short periods, usually less than a year. It's all about managing their immediate cash needs. Like, a bank might need extra cash to cover withdrawals, so they borrow in the money market.
And then there's the foreign exchange market, the Forex market, where different currencies are traded.
The Forex market is huge, the biggest financial market in the world. Trillions of dollars change hands every day. You've got companies doing international business, central banks managing their reserves, and individuals and institutions speculating on currencies.
Okay, let's talk more about stock exchanges. What role do they play?
Stock exchanges are regulated marketplaces where people buy and sell shares. There's the primary market, where new shares are issued for the first time, usually through IPOs.
Initial public offerings.
Right. And then there's the secondary market, where investors trade shares that have already been issued. The secondary market is what makes it easy for people to buy and sell shares.
And those share prices are always changing, driven by all sorts of factors.
Absolutely. A company's financial performance, supply and demand, economic conditions, news events, you name it. Good news about a company usually makes its stock price go up. Bad news makes it go down.
Yeah, investors are always trying to predict what's going to happen to those prices. We've got two main approaches mentioned here: fundamental analysis and technical analysis.
Fundamental analysis is about figuring out a company's intrinsic value.
Okay.
You look at their financials, their management, their competition, the whole economic environment. The goal is to figure out if a stock is underpriced or overpriced.
So you're looking at the actual company?
Right. Technical analysis is different. It focuses on historical price movements and trading volumes. The idea is that past trading activity can tell you something about future price trends.
Interesting. Two very different approaches. There's also something called arbitrage.
Arbitrage is all about taking advantage of price differences for the same asset in different markets. Like, if a company's stock is trading for slightly different prices on two different exchanges, you could buy it on the cheaper exchange and sell it on the more expensive one at the same time, making a profit from the difference.
It sounds like you'd have to be really quick to pull that off.
You do. It often involves sophisticated algorithms and high-speed trading. The profit on each trade is usually tiny, so you need to do a huge volume to make it worthwhile.
Wow. Then there's day trading. That's buying and selling within the same day, right?
Exactly. Day traders try to profit from those little price swings that happen throughout the day. They might hold a stock for minutes or hours. It's high risk, high reward, and not for the faint of heart.
Definitely not. Okay, we've talked about how companies raise money and trade shares. Let's shift our focus to the institutions themselves, the financial institutions. How do they make money?
Institutions like commercial banks, their main source of profit is lending. They lend money to people and businesses, charging them a higher interest rate than they pay to their depositors. They also make money by investing the money people deposit with them.
And they charge fees for all sorts of services, too.
Exactly. Account maintenance, payment processing, financial advice, the whole nine yards.
What about investment banks? They seem to play a different game.
They do. Investment banks work with corporations and governments. They advise on mergers and acquisitions, help companies raise capital by issuing new shares or bonds, and underwrite new securities, which means they guarantee a certain amount will be sold.
And insurance companies.
Their business model is all about risk. They collect premiums from people and businesses who want to be protected against certain events, like fires or accidents. They pool those premiums and invest them, hoping to make more money. They make a profit if the premiums and investment income are higher than the claims they have to pay out.
Got it. Now let's talk about the overall supply of money in an economy and how governments try to manage it.
This is where central banks come in. But what's interesting is that commercial banks actually create money when they lend money.
How does that work?
When you deposit money in a bank, they're only required to keep a small percentage of that deposit in reserve. The rest, they can lend out. That borrowed money then gets spent and deposited in another bank, and that bank can lend out a portion of that deposit, and so on. It creates a ripple effect.
It's like that initial deposit multiplies through lending.
Precisely. But this can also work in reverse. When people lose confidence in the banking system, like during the Great Depression, they rush to withdraw their money, leading to bank runs. This can cause banks to fail and drastically reduce the money supply.
So for an economy to thrive, you need a good amount of money flowing around. How do governments try to control this?
Central banks, like the Federal Reserve in the US or the Bank of England, They're the ones managing the money supply.
Okay.
They have a few tools they can use. Open market operations is one, where they buy or sell government bonds.
Buying bonds puts money into the economy.
Right. Selling bonds takes money out. Another tool is quantitative easing, or QE, where they buy assets, usually government bonds, to increase liquidity in the financial system.
Okay, so central banks have these tools. Governments themselves also have ways to influence the money supply through taxes, borrowing, and spending, right?
They do. That's called fiscal policy. But directly controlling the money supply in a complex modern economy is tough. Central banks have a lot of independence, and commercial banks make their own lending decisions, even though those decisions are influenced by the central bank's actions.
Okay, so central banks are really important. What about government finances themselves?
Right. We need to talk about national debt. It's the total amount of money a government has borrowed over time. And remember, they have to pay interest on that debt.
And governments usually have plans for how they're going to raise money through taxes and what they're going to spend it on.
That's their fiscal policy.
Those government budgets have been under a lot of scrutiny lately, especially after the 2008 financial crisis.
It's understandable. Debt levels and the sustainability of those spending plans are a big deal. Transparency and accountability are super important, especially for central banks because they have so much power.
People want to know what they're doing and why.
Absolutely. There's also this ongoing debate about how much the government should be involved in the economy. You know, the traditional view is that there's a trade-off between inflation and unemployment.
Right.
But more recently, a lot of economists are saying that economies work best when the government doesn't interfere too much.
So governments mainly raise money through taxes. There are direct taxes, like income tax, and indirect taxes, like sales tax.
And those tax systems vary a lot from country to country. Then there's this idea of the Laffer curve, which suggests there's a certain tax rate that actually maximizes government revenue.
A sweet spot, so to speak.
Right. But finding that sweet spot is really tough. It depends on a bunch of factors.
So where does all that tax money go?
Governments spend money on a ton of things. Education, healthcare, infrastructure like roads and bridges, defense, social programs, the court system. That spending can have a big impact on the economy.
It can stimulate demand, fund research, improve the workforce.
Exactly. Some of that spending is considered government investment, like building new public transportation.
And that kind of investment can have long-term benefits.
Right. It can generate revenue, boost local economies, and create jobs. Okay, let's talk about some key economic indicators.
Okay.
Inflation, balance of payments, and exchange rates.
Inflation is basically prices going up.
Yeah, it's the rate at which prices for goods and services are rising.
So the value of your money goes down.
Exactly. It's usually measured as a percentage change over a year. There are different types of inflation, like cost-push inflation, which is when production costs increase, and demand-pull inflation, which is when demand is higher than supply.
Got it. What about balance of payments?
A country's balance of payments is a record of all its economic transactions with other countries. It tracks things like trade, investments, and transfers of money.
Okay.
And then there are exchange rates, which is how much one currency is worth compared to another.
Those rates are always changing.
Always. It's all about supply and demand. A country with a strong economy and stable politics usually has a strong currency. Things like economic uncertainty or political instability can cause a currency to weaken.
So what happens when governments borrow too much money?
Ideally, government borrowing should be manageable. But things happen, like economic downturns or unexpected global events, and governments might have to borrow more than they planned. If debt gets too high, the government has to use a lot of its revenue just to pay interest. To deal with that, they might raise taxes or cut spending. In extreme cases, they might even default on their debt.
Which is basically saying they can't pay it back.
Exactly. That can really damage a country's reputation and make it hard to borrow money in the future.
Okay, let's shift to personal finance. How can individuals build wealth?
The first step is to figure out where you stand financially. Calculate your net worth.
Net worth is what you own minus what you owe, right?
Right. Your assets minus your liabilities. Once you know your net worth, you can set financial goals. Then it's about saving and investing. Even small amounts saved regularly can add up over time.
Especially with the power of compounding.
Exactly. Compounding is like magic.
It really is. We often hear about active income and passive income.
Active income is what you earn from your job. Passive income is money you make from investments or other sources without actively working. Building wealth is often about increasing your passive income.
Makes sense. So what are some good investments for someone who wants a steady income stream?
Dividends from stocks are a good option. Companies that pay consistent dividends can provide regular income. Savings accounts and fixed-term deposits are low risk, but the returns are usually lower, especially when interest rates are low.
What about managed funds?
Managed funds can be a good way to get income, too. A fund manager invests your money in a bunch of different assets. Some funds focus on income-generating investments, like dividend-paying stocks or bonds.
Okay, so those are some income-focused investments. What about investments that will grow your capital over the long term?
Property is a big one. You can rent out property for income or sell it for a profit later.
But the property market can be unpredictable.
It can. It's important to understand the factors that drive property prices.
Home equity is also important for